Ben Reppond. Welcome to my YouTube broadcast. Today is November 14th, 2023. I'm going to begin with a piece from Mohamed El-Erian and whether interest rates go up or down from here. My guess is they will go up and down. And regardless of whether inflation goes up from here or down, and it will also probably do both, he makes the point that we are going to have continued volatility. When you look at this year and even last year, you would say definitely the market, the stock market, and especially the bond market has volatility. He expects that to continue. Take a listen to this piece from Bloomberg. Jonathan Ferro is interviewing Mohamed El-Erian.
What a rally in the equity market inspired by a major bond market move. Your piece this morning, let's get straight to it. This line right here, for all of us who hope for greater certainty and less yield volatility. Mohamed, how disappointed are we going to be?
Thanks for having me, John. First, the rally has been driven not just by lower yields and a ton of refinancing that has allowed the capital structure to be strengthened for companies, but also by lower oil prices. Don't underestimate the impact of oil prices, both on the supply side and on the demand side, when it comes to the tip of a company. Now, we all want more stability in the treasury market. The treasury market is central to so many other markets, and having 8 to 15 basis points moves every day as something regular is not good for the functioning of that market. It's not good for other markets. It's not good for the economy. It's not good for the standing of the US in the financial system. So we all want greater stability. The Fed is moving off center stage. The Fed is going to have much less of an influence on where rates go from here. But unfortunately, that doesn't mean that the volatility is going to go away, because you have a tug of war that we're going to see playing out between issuance and between a softer economy. And that tug of war means that we're going to continue to see this volatility. But I don't think to the extent we've seen it before, because the Fed is not going to be confusing things anymore.
So do you think we are confusing a rally in the bond market with stability?
Well, it hasn't even been stable, John. Yesterday, we moved 8 basis points, and the stock market did nothing at all. But the bond market is still moving. There's still a lot of underlying tensions in that bond market. Issuance, John, I'll give you an example that comes from a colleague at Gramercy. For the whole of October, there was 14 billion of issuance in emerging markets. This week alone, there's been 14.5 billion. So this week alone, everybody has rushed, understandably so, to issue because the volatility had kept them on the sideline. So the issuance element is contributing to what we see volatility, even though I agree with what most people will think, which is the Fed is done. It certainly should be done, and I suspect it is done.
Next, Becky Quick and Joe Kernan talk about Mike Wilson. Mike Wilson's the chief U.S. equity strategist for Morgan Stanley. He was also named among his peers with a survey of investment managers. He was named Portfolio Manager of the Year. Morgan Stanley and/or Mike Wilson have been named Portfolio Manager of the Year for the last 7 straight years. Wow. That's impressive. But he has been, since last year, he has been bearish on this year, most of the year. They comment about this, and they don't put him down as much as Bloomberg does, but they are kind of mocking him a little bit for his bearish stand, and the market has been pretty resilient. But his point is, and they make his points for him, and that is there's going to be continued inflation. Earnings are going to continue to struggle, and it is basically going to be a tough market. I think Mike Wilson, and I'll play this brief clip for you, I think he has it right. I mean, it's just, the way I say it is, there's nobody in the room smarter than Mike Wilson. And I think he's got it right. But when he makes predictions like he has made, they can be off a little bit. When you put a time frame and make a prediction, I don't know how anybody does that. I don't do it. I try to stay away from predictions, and I certainly would stay away from time frames. I might give this is my view, but I don't really make it as a prediction. So he sticks his neck out and says, based on earnings, this is, and they know what the earnings projections are for all these companies. He believes that the market is coming down. It hasn't done that. It hasn't done it on the schedule that he predicted. It did come down during the third quarter about 10%, but it did not hit his targets. And I think his targets are going to be correct. We just have to see out for another quarter or two, and I think he'll be validated. It's just an opinion. But anyway, it's an interesting view, and I give them credit for talking about him and what his reasons are and mentioning it. But when he's right, they will be bringing him on for him to explain why he's right. My opinion. Okay, take a listen to Becky Quick talking about Mike Wilson.
New this morning, Morgan Stanley's Mike Wilson saying an end-of-the-year rally for the markets is unlikely. Wilson says that narrowing breadth, cautious factor leadership, falling earnings revisions, and fading consumer and business confidence tell a different story than the consensus, which sees a rally into year-end. Wilson, of course, has been bearish over the last several months and says fourth quarter and 2024 profit expectations are too high, even in an economy that is performing well.
Next, Morgan Brennan from CNBC talks about the U.S. debt. And this last week, Moody's retained their rating for the U.S. credit of AAA. And that's the highest rating that you can get. The other services, S&P and Fitch, have downgraded U.S. debt, but Moody's has stayed with a AAA rating. However, this is so interesting to me. Moody's went on to say they downgraded the outlook to negative. So here you're holding a AAA rating, the highest rating, and then you are downgrading the outlook. I just think, to me, it sounds like it's just politically correct. We don't want to be the one out there downgrading the U.S. credit. But, oh, by the way, we're downgrading to negative the outlook. Which one is it? I think they kind of want it both ways. So, but anyway, take a listen to Morgan Brennan explaining this.
Breaking news here out of Moody's. Steve Kovak has the details for us. Steve.
Yeah, Morgan, Moody's downgrading its outlook on the government of the United States. I'm just reading right here from the report that just came in here. It's saying ratings to negative from stable, but still affirming the long-term rating of AAA. Some of the reasons behind this, Morgan, are the downside risks to the U.S. fiscal strength and also continued political polarization within the U.S. Congress raises the risk, I'm quoting directly here, raises the risk that successive governments will not be able to reach consensus on a fiscal plan. And of course, we're a week away from a shutdown where this is all playing in. And of course, this comes a little over 3 months after that Fitch downgrade, Morgan.
Okay, Steve Kovak, thanks. Mike Santulli, I'm going to go back to you because some of the other headlines here. Political polarization exacerbates fiscal risks. Absent policy action, fiscal strength will decline. Debt affordability to be significantly weakened. None of this is necessarily breaking news, and there had been a lot of anticipation that maybe you could see a move like this by Moody's. But how significant is it that we are getting it? We're getting on a Friday, a week to the day before the current continuing resolution that the government is operating on is set to expire.
Yeah, so it doesn't bring with it any tangible direct impact in terms of, any big institutional investors having to change their willingness to hold U.S. government debt. It does crystallize the concerns, though, as you say, we've been dealing with for a few months. Not just this huge supply of government debt that's been pushed on the market because of these large deficits in a time of economic expansion, but also, and this gets back to what Fitch said around the debt ceiling standoff the last time, which just does seem like politically it's not about the ability to meet our debt obligations. It's sort of the willingness to kind of place the fiscal situation on a more secure path. So I would say it's basically giving words to what the market has been struggling with since July when yields started to really ramp higher. And by the way, that whole move higher and ramp was not all about supply, but that definitely was an exacerbating factor.
Yeah.
And then I thought I would go over to Bloomberg and play their clip from Michael McKee, who was also talking about the downgrade of the outlook for the U.S. Credit and, of course, retaining the AAA long-term rating. So take a listen to this from Michael McKee from Bloomberg.
The United States outlook has been cut to negative from stable by Moody's. So the actual credit rating of the U.S. remains the same, and Moody's has affirmed that AAA rating, but it has downgraded the outlook. So I want to bring in Michael McKee, who, of course, is our go-to for all things economics and policy. Michael, this would be the last U.S. rating company that has kept the U.S. at AAA, correct?
That's correct. It was 2011 that S&P downgraded the U.S. during the budget problem that year, and then it was only a year ago that Fitch downgraded the U.S. Now, the question is, would Moody's doing it add anything to that? There's some question about whether it would matter all that much, in the sense that in some cases, portfolio managers wouldn't be allowed to own downgraded stocks, but downgraded to AA from AAA probably would not be a major issue. And then you go back to the 2011 experience, it had an immediate impact in the bond market that 2 days later was gone. So it's a black mark, but it probably doesn't mean a huge amount unless they actually do the downgrade, and then we'd have to see what effect it would have on bond yields.
Next, there's a piece. Scott Wapner is interviewing Jason Snipe, Jim Lebenthal, and Liz Young. And I thought this was so interesting. Particularly Lebenthal and Liz Young talk about they're trying to put a spin on how, even though the broad market for the stock market is down, I mean, it's negative. You've got the Magnificent Seven who are holding the market up. Apple, Amazon, Google, Microsoft, Netflix, Tesla, Facebook, they're holding the market up. And the rest of the market, mostly, there's some other tech stocks that are positive, but a lot of the market has not done that well. So it's all focused on the Magnificent Seven. But they are trying to put a spin on this to show that the overall market, well, it may not be that great, but it's going to recover, it's going to go up, and so forth. It's just nothing but spin. And when you listen to the traditional financial advisors or the financial media, they're always putting a spin. They always want the market to go up, and it's just not reliable information. But I'm playing it not because I thought it was wonderful, but because I thought it was a wonderful example of spin. So take a listen to all of this, but particularly the last couple of people, Lebenthal and Liz Young, of how they are trying to spin the fact that, you know, the market's going to go up, or it may be bad, but it's going to eventually go up. Take a listen.
Energy worst performing sector today. Oil breaking below $80, down nearly 4%. Take a look at that. Jason Snipe, you got Chevron, you got the XLE, you had a sector pick in our summit. Chevron's at a 52-week low today. What's happening here?
Yeah, obviously a Chevron stock. I mean, Chevron, the chart is an ugly chart, right? So it's
ever since earnings.
Ever since
right?
Earnings. Ever
Oil's
since
below
earnings.
its 200-day moving average today as well.
You got it. You got it. And I do like the acquisition of Hess a couple of weeks ago. I think that will be long-term accretive to the stock. I mean, but the stock's down 20%. You know, the 200-day was at 161. I think it's trading at 143 right now. So not happy about it, but I do believe the structural, tailwinds of the supply and demand mismatch still do exist. And I do think that will be a play for the energy stocks, but the earnings have not been great. And what I will also say about energy, just the greater complex, is free cash flow is an important factor for me. And a lot of these stocks have a ton of free cash flow, so they have optionality in what they could do with that. And that's why I still own energy, XLE, as well as Chevron.
Down near 4%, Jimmy, on the week. Is that space? Quarter to date, excuse me, down 8%. You got Cheniere, you got Transocean, you got Exxon, and you're pretty overweight this space.
Yeah, I'm overweight because I'm still bullish on it. I agree with what Jason said. At the heart of this, there is for the next year likely to be a supply-demand imbalance. When we talk about these imbalances and a deficit, sometimes it's like less than 1 million barrels a day out of global oil demand of 100 million barrels a day. But the thing is those small numbers matter. There's no place to get them. And OPEC doesn't look like it's going to open up the spigots anytime soon and help. Unless you have the recession that some people are still calling for, that demand is going to be there, and it's going to promote energy prices to stay at this level. What I think has gone on with the space, honestly, is this whole year, it's been up and down and up and down. It's gone nowhere. It's a consolidation of the prior 2 years, in my opinion, of just a breathtaking run. And I think that breathtaking run after this year is going to pick up.
Liz?
Yeah, I wish I could offer something juicy here and disagree, but I agree actually with what both of them said. I think supply and demand is going to drive this going forward, and that's coming from somebody who is cautious on the economy.
Yeah, that's what I'm saying.
Where demand should fall apart and be a problem. I think this has been and will continue to be driven much more by supply constraints than demand breakdown. And in a year where energy has been a laggard in the S&P, coming off of a year, to Jim's point, of up 60%, I think valuations still look attractive. Earnings have been tough, but I think they will come back, because if that's the worst of it, then we're on the other side. And with supply constraints, you've got that feeding into margins as well.
Well, the wild card, of course, the Middle East.
Of course.
The dynamic on prices can change in an instant.
Next, I want to show a chart. This is the last thing I'm going to do today. Show a chart showing the University of Michigan Consumer Sentiment Index. And the University of Michigan does this ongoing. They've done it since 1952, and it's relied on as a good indicator for what is the consumer thinking as far as sentiment. Are they up for spending and the growth economy, or is it contracting and going the other way? When you look at this chart, I know it looks like a lot of up and down, and it is, but I want to draw your attention to a few things. I put at the bottom of the chart, I put 4 black arrows. These were the lowest points up through 2012. These were the lowest points that the index has come down to. Then in 2022, the Consumer Sentiment Index went all the way down further than it has been since 1952. Wow, that's over 70 years. 70 years, it just hit the most negative number last year. And this year, then it went up, and now it's come back down. So it's now at about, relatively speaking, about a 60. The worst it was, in 2022 was down to a 50. The highest it's been is around 112. So it's still very low and actually falling. So the market, the stock market, or your view of the economy may be positive, but the consumer sentiment, the attitude, feelings, willingness to buy goods from the consumer is quite negative. And so I thought it was interesting, because when you hear, like I just played, you hear the financial press talking about, that the market is wonderful, or maybe it's not wonderful, but it's going up, and they're putting a positive spin on it. That's not what people are feeling. It's pretty negative. So this came from the University of Michigan, the St. Louis Fed, and shadowstats.com. Okay, the Fed today explain the reason they raise interest rates is so they can lower them again. And sometimes it seems like that, doesn't it? They're going up, and then you think, okay, pretty soon they're going to start dropping them, and vice versa. Anyway, talk about spin. Thank you for watching. If you have comments or questions, leave them in the comment section below.